Bob, let's talk about gold's performance this year because it has far surpassed the S&P 500. Now Goldman Sachs predicting that it could hit 4,900 by the end of 2026. So what's your outlook for the new year?
Well, I've been long gold for a couple of years, Brooke. As you know, I talked about gold in 2023 on this show, as a matter of fact, as being one of the big holdings going into 24. And I've seen no reason to get out of that position at this point. I do think we'll get a substantial pullback, but I think the central bank buying is going to resume and accelerate into 2026. I think this is sort of a de-debt, de-US debt, de-dollarization, sort of a narrative that has not changed globally. So I see that continuing. And that, of course, was some of the geopolitics that went on over the last couple of years are a big part of it. So I don't really see that ending, but I don't see the type of parabolic move we've seen in gold continuing. I think those who are long gold need to stay long gold, but I don't really think it's time to initiate new positions in the precious metals.
So, Bob, it seems like you're kind of contradicting what exactly we're hearing from Goldman Sachs. We heard from global data this morning. They're predicting between 4,900 to 5,100 by the end of next year. Walk us through that hesitation that it seems like you have. And also, it seems like investors shouldn't be jumping in right now. Is that what you're saying there?
Well, I think that's sort of, given where gold is, I don't think that's a very big call. And that's sort of what I mean. I mean, when you mentioned the kind of rally we've had this year, I just don't see that continuing. So you get to a certain point with commodities, especially, where you've seen such a run that the reward to risk on getting into new longs is not necessarily that intelligent for me from a trading perspective or from an active investing perspective. The kind of thing that I do when I get these big runs is I rebalance, take some of those gains and put them in more constructive areas, like some of the AI sectors, for example, which have also had big runs, but have sort of leveled off over the later part of 2025. So it's not that I'm disagreeing with Goldman Sachs. I just don't think it's a very bold call, and it doesn't call for new gold positions in my view.
Now, some of the other areas of this gold trade that have seen such momentum this year include some gold miners. We have Barrick, Freeport, Newmont seeing tremendous returns. We also have ETFs also seeing tremendous returns as well, with Van Eck Gold Miners ETF up more than 160%. What do you make of investors trying to play this gold trade maybe a little bit differently? And is that the right move in the new year?
So that might be a more conservative way to play 2026. And I'm glad you brought that up, because some of the gains that I made in the commodity itself, I moved into the Van Eck fund specifically because it's going to have a little bit more complex of a move than gold itself. One thing I've talked about for years with precious metals and also with energies like crude oil is that if you have a thesis in the commodity, you should be invested in the commodity, not in the oil drillers or in the large oil companies like Valero or Exxon. If you have a thesis in oil, you should be in oil. I feel the same thing for gold, except when you end up in a situation where the price of gold might stabilize. The miners are still going to be taking advantage with larger margins of this higher gold price, even if gold stabilizes, and their P&Ls and their profits and their earnings report will reflect that. So some of the places you could establish new longs, if you believe in Goldman's call or anyone else's call for that matter, because there's not a lot of calls for gold to drop off the face of the earth, you're looking at the miners as being a better play in my view.
Bob, another precious metal that has seen a 150% return this year is silver. We are seeing some momentum this morning. Break down what's driving this momentum on one of the last trading sessions of the year, and also that run that we've seen this year to date.
You know, historically, silver has suffered from its classification as being both industrial and precious, because the precious metals could be rising, but then silver could have a headwind from the industrial sector in the case of when gold is rising during recessionary periods. This particular story is huge for 2026. So silver has the precious metal component, not as strong as gold, but it also has the electrification story, the AI demands for electricity, not as strong as copper, but it has both. So this is the first time in recent history where silver has gotten to take advantage of that. Now, again, parabolic moves, you have to be careful about new entries, but silver itself can fall 15% and is still probably a good buy for 2026.
Bob, you mentioned that within the answer that it hasn't seen the same sort of demand as copper. I do want to get on
Right.
copper because it's on pace for its biggest annual gain since 2009. Break down what exactly is driving that demand and just how much has to do with it with this AI build out that we're planning to see in the year to come.
Yeah, it's interesting with copper, as we saw the green energy story kind of fade into the background. It's not gone, but it certainly has lost its sort of momentum. You're seeing the AI electrification and the build out that has to happen. One of my key stock picks for next year is actually AMD. I was happy to see the interview that just preceded this show. And that, again, the build outs, those things are not going to end. They're 3 and 5 year stories right there. So copper is going to benefit from that. I think copper is one of the best commodities plays for the medium to long term. For me, medium term is 5 years. So when you're looking at it from that perspective, I think copper is going to continue to operate in a structural deficit when you look at the projections of the need for this particular industrial metal.
We are at another record for these two precious metals. Silver alone is up 40% in the past month. This is a massive gain.
It's incredible what silver has done. And strategists are saying that, we have seen short squeezes on silver before, but this is now, you are seeing a deficit in the market. This is what they're saying is different from other times. Silver, the best conductor of energy, of electricity. You also have copper that is the second best, and copper has also been at record highs as well. So yes, these are industrial uses for the metal. That this is where strategists are saying why they are so bullish on this, because you do need these metals in order to, if you're going to do manufacturing, data centers, onshoring, etc. This is the use for some for those metals, and you've seen these mega moves in this. Now, I will say that I have spoken to at least one strategist that says be wary of these levels. I mean, you are buying at record high levels, and he's saying that the last time we saw this type of move with silver was in 1979, 1980, and then you saw the metals crash after that. So it just depends. Again, you have, though, some strategists that are saying that in this case, it's deficit. When it comes to gold, it's a different story because you are seeing central banks that are acquiring gold, et cetera.
Keith, I could sure make the case that we are right in the middle of a precious metal, or towards the latter stages of a precious metal bubble, more so than we are at an AI bubble.
Yeah, the charts tell a simple story. It's been straight up and to the right for gold and silver as well. We have both in our strategies, our global macro strategies. And we feel like the gold allure, and which is why we have a heavier position than silver at this moment, kind of mitigates a lot of risks that we look at from a global macro standpoint, whether it's fiscal here in the U.S. or worldwide. Also, the monetary policy mistakes that have the potential to really propping up in 2026 as well. So we're exposed to both. Copper is one that Dr. Copper's been looked at as a barometer of the expectation of global global economic growth. And that's why the latest run was 2005 to 7 during the build out of China from an industrial standpoint. We really don't see that demand right now. So we feel like there's some froth or sentiment that's bubbling up that's really getting into the prices of gold, silver, and copper. Copper, we feel like has a little more to lose, as the industrial demand of it really doesn't really speak to the prices that we're at right now. So we feel like gold and silver have a little more risk reward to it, even at these levels, to our clients' portfolios than some industrial metals like copper.
Keith, how do you screen or decipher when it's time to cash in on these gold and silver moves that you've had success with?
Sure, we've trimmed some gold. We actually trimmed some gold and bought some silver, and then trimmed gold outright here recently in the last several months. Right now, it's a matter of how are we looking at the long-term price of gold, as well as we own some of the gold miners as well, and that has a little equity exposure. But right now, we've owned these for a couple of years, is the gold positions that we have. So we're just looking at good points on the charts, frankly, to step away and monetize some of the profits. But we still have a bullish outlook on the metal itself. We've taken down some of our exposure just to be rational and frankly, to be responsible for our clients' portfolios. We feel like it got a little bit ahead of itself, but we're still optimistic going forward on the allure of the metal.
Well, precious metals rallying here with gold and silver hitting new records as crypto is left in the dust. Here with a look at these alternative assets is our very own Inez Ferreira. Inez.
Yeah, Josh, as you just mentioned, precious metals absolutely on fire. I mean, you look at gold right now, it's up more than 70% year to date. You're also looking at silver, that's up 165% year to date, and platinum up 175%. And now compare that picture with the crypto scenario, where a year to date chart of crypto shows you this: Bitcoin down 7% year to date, unable to recover from its around 30% drop from its all-time high in October. Ether down more than 12% year to date. So you now have metals investors that are basically saying it's time for the crypto crowd to switch to the metals. It's less volatile. There's more liquidity when it comes to gold. You also have been having some prominent Bitcoin bulls that have been noting that Bitcoin has been trading like a high-risk tech stock and not a neutral reserve asset recently. But I will say that you do have some strategists that are noting that after this big decline that we've seen with Bitcoin, you probably will be seeing a bounce in January. That's because if Bitcoin goes towards its third month of losses, if December is a down month for Bitcoin, well, then that it has only happened 15 times. And that generally sets up the token for a bounce in January. That's according to Sean Farrell from Fundstrat. So he is optimistic that we may see a near-term bounce in January. And also as investors sort of allocate their portfolios, allocate some crypto in their portfolio long-term. We have seen, though, Wall Street that has been paring back their estimates, their price targets for the end of 2026. Sean Farrell Fundstrat has 115,000 by the end of next year. And then you've got Standard Chartered that has 150,000 price target for Bitcoin by the end of 2026. Josh.
All right, Inez, thank you. Appreciate it.
Thank you.